Welcome to First Issues. When it comes to borrowing money or acquiring loans, most people have the experience of walking into a financier, for example, a bank. Similarly, a corporate or a government can also do the same. But maybe what you don't know is they have another alternative, issuing bonds.
Simply put, bonds are loans an entity such as individuals like you and I make to a government agency or corporation, which they use to finance projects and other needs. The bond issuer, herein known as a government agency or corporation, agrees to repay the entity a fixed interest rate by a specified date. As an investment tool, bonds are generally considered an essential component of a diversified investment portfolio. They bring income to a portfolio while typically carrying less risk than, for example, stocks.
In Botswana, the government's bond program, also known as the Domestic Note Issuance Program, allows the Bank of Botswana, or the BOB, to raise debt in the local capital market on behalf of government. Through this program, domestic debt is capped at 55 billion pula, which is within the domestic debt limit at 11.05% of gross domestic product (GDP).
This means, as an investor, one would have the opportunity to lend government a portion of the 55 billion pula and have it returned with interest.
But how does one become a player in the bonds market? Chairperson of the Botswana Bond Market Association, Boikanyo Kgosidintsi, firstly unpacks the performance of the Botswana bond market and then further details exactly how bonds work. Boikanyo, thank you so much for being on First Issues and affording us your time. We're here today to talk to you about the bond market. Let us start first by unpacking how the Botswana bond market has been performing.
Well, thanks for having me. We've had a bond market for quite some time, probably 30 odd years. But I think there are two aspects of the bond market that we need to look at differently. So the first part is the primary bond market, which is where companies and government parastatals go to market to raise capital. And that, I think, is pretty well established. We've got a sizable market capitalization, which means that a good number of parastatals, corporates, government have come to the market to issue paper, and investors have bought those bonds. Where I think the challenge is around secondary market trading. So typically what happens is investors will buy those bonds, they will hold them, and they will not trade them. But what we really, really need to get going is a secondary bond market where investors are able to buy and sell bonds. Because what that does is, in bond parlance, it creates price discovery. It reflects the true cost of raising capital on the bond market. And unfortunately, given that our bond market is illiquid, then it becomes very difficult to price those financial instruments.
Let us bring down our conversation to the most basic level, right, for everybody who's watching this to understand. Start by explaining to us the types of bonds that are available in the market for anybody who's wishing to invest in them, especially individuals like you and my group.
Typically, individuals access the bond market through institutional savings, so your pension funds, your provident funds, etc. These are assets that are managed by asset managers. So it's not very often that an individual with 100 pula, 200 pula, whatever the case may be, can go and purchase a debt instrument. Is that ideal? Is it not ideal? We need to understand a couple of things, right? One, you're making a financial investment. Do you have the skills to evaluate the risks versus the rewards? And if you don't, you probably need to outsource that to somebody else. And that's why the asset managers are there. They manage these portfolios on behalf of individuals, as well as pension funds and other institutions. So that's the first thing to consider. Secondly, it's like with any financial investment, there's risk. Do you understand the risks well enough as an individual to be able to protect yourself in the event that there is a rise in interest rates, which has an impact on the value of the bond? Having said that, for the more sophisticated investor, you've got two types of bonds, essentially. You've got corporate bonds and you've got government bonds. In the Botswana market, the government of Botswana issues bonds. They are priced at what is called the risk-free rate, so they are probably the least riskiest of bonds that are out there in the market. And corporates pay what we call a spread, so it's an amount slightly higher than government because corporates are perceived to be more risky than the government of the day.
Earlier you were talking about risk, right?
Yep.
And understanding that. So then from that context, let us try to unpack the economics around bonds. What is there, or what certain factors determine how bonds perform that you need to consider as a potential investor?
Bonds, by their very nature, pay out what is called a coupon. So they pay interest on the amount of debt that is outstanding. That coupon, in most cases, is fixed. So if I put in 100 bula today and I buy a bond with a fixed coupon, and that coupon is, say, 5%, I know that when that instrument matures, I will get a fixed rate of interest over whatever intervals that bond pays out. You also get floating rate notes. So the floating rate notes means that the interest moves up and down depending on what is happening in the rest of the economy. So your biggest risk if you hold a bond is that movement in interest rates, because that then has an impact on the valuation of the bond, which means that you can lose money, which is a capital loss, or you can make money, which is a capital gain.
Well, in closing, how does a person go into buying bonds? And that is why we're here, to encourage people to actually invest in bonds.
The way that the market is structured is we've got a stock exchange where the bonds are listed. We've got brokers who act as agents of investors. So you can go to a broker and tell them that you are interested in an exposure to the bond market. I think the most likely response would be, we will put your money into a unit trust. So a unit trust pools your money with other people's money, and all that gets invested in that particular instrument.